Good morning. It is Thursday, May 21st, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the maritime crisis in the Middle East has entered a highly complex phase following a 2-month commercial paralysis. Shipping data from LCG and CLR confirm that for the first time since the outbreak of hostilities on February 28, 3 supertankers have successfully exited the Strait of Hormuz carrying 6 million barrels of Middle East crude oil bound for Asian markets. This marginal movement, however, does not signal a return to normalcy. The United States Navy-led Joint Maritime Information Center issued a stark warning yesterday, noting multiple instances of aggressive hailing and assertive action by Iranian units within the last 48 hours. Shipping industry associations have concurrently released new navigational guidance, warning hundreds of stranded vessels that the corridor remains an exceptionally high-risk zone fraught with the threat of drones, sea mines, and severe traffic congestion. Consequently, while selected transits are being recorded, the strait remains functionally closed to predictable large-scale commercial navigation.
Transitioning from the theater of conflict to the broader global economy, the macroeconomic fallout of this prolonged maritime blockade is taking a devastating toll on labor markets and international growth. A joint report issued by United Nations agencies, including UNCTAD and the International Labour Organization, has officially downgraded the 2026 global growth projection to 2.5%, a figure well below pre-pandemic baselines. The analysis reveals a cascading cost-of-living crisis across developing regions, driven by surging energy costs and inflated transport insurance premiums. Under the ILO's newly modeled risk scenario, if oil prices remain 50% above their early 2026 average, global working hours could contract by up to 1.1% by next year, threatening the equivalent of 38 million full-time jobs worldwide. This structural drag is increasingly acute in East Asia's economic engine, where growth is projected to slow to 4.4% as mounting input costs and trade uncertainties erode industrial margins and disrupt traditional migrant labor corridors.
In the realm of finance, these persistent, energy-driven inflationary pressures are casting a long shadow over the inaugural days of Kevin Warsh's tenure as chair of the Federal Reserve. Following his narrow 54-45 confirmation vote in the Senate, the most politically divisive in the history of the central bank, Warsh has officially taken the helm just as consumer price inflation hovers at a 3-year high. Wall Street is adjusting to a dramatic regime change, with J.P. Morgan wealth management strategists predicting that the Fed will keep interest rates completely steady through the remainder of 2026. Institutional investors have effectively abandoned any expectations of a near-term rate cut, with less than 3% of market participants pricing in an easing cycle at any remaining FOMC meetings this year. This hawkish pause reflects a deliberate shift in Fed methodology, as Warsh is expected to favor trimmed averages that drop extreme price shocks to address baseline inflation, signaling a long-term commitment to price stability even as the credit cycle tightens.
Turning our attention to the technology sector, the macroeconomic headwinds generated by this energy crisis are accelerating a monumental restructuring of domestic utility infrastructure to support the artificial intelligence boom. A newly released report by the International Data Center Authority reveals that data centers now consume a historic 2% of the world's electricity, with AI-focused facilities driving a 17% surge in power demand over the past year alone. This unprecedented consumption has triggered massive corporate consolidation on the United States East Coast, exemplified by NextEra Energy's historic $67 billion acquisition of Dominion Energy, a deal designed specifically to secure the massive scale and capital efficiencies required to power the dense concentration of data centers in Virginia. Simultaneously, the industry is facing mounting societal and regulatory scrutiny, as forensic audits reveal that over 3 gigawatts of power, equivalent to the output of 3 nuclear reactors, is being wasted globally on idle, zombie cloud containers, forcing hyperscalers to drastically re-engineer their infrastructure efficiency.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now absorbing the permanent structural adjustments of a fractured maritime map. Alphaliner data confirms that the global container fleet is currently operating at a maximum deployment level, with idle capacity sitting at a mere 0.7%. This extreme tightness is a direct consequence of shipping lines permanently integrating the Cape of Good Hope detour into their standard schedules to bypass the volatile Middle Eastern choke points. This detour, which adds up to 20 days to standard voyage times, has completely absorbed available vessel supply and triggered widespread operational disruptions. The financial toll of this supply chain shock is manifesting in the corporate landscape, as evidenced by the liquidation of major debt-laden carriers, such as Spirit Airlines in the United States, which was entirely crushed by compounding liabilities and escalating bunker fuel costs, proving that the era of low-cost, just-in-time logistics has been permanently replaced by a high-cost strategy of regional resilience.
In summary, the global landscape is defined by the limited and high-risk transit of 6 million barrels of oil through a still-paralyzed Strait of Hormuz, occurring as the United Nations downgrades global growth to 2.5%. The Federal Reserve has entered a prolonged pause under the hawkish leadership of Kevin Warsh, while the technology sector witnesses a historic $67 billion utility merger to sustain AI data centers, and the logistics industry grapples with near-zero idle capacity and rising corporate liquidations. Based on the current trajectory, I predict that the limited transit of supertankers recorded this week will not lead to a meaningful reduction in global energy or logistics costs. The assertive actions by Iranian naval units over the last 48 hours demonstrate that Tehran has no intention of relinquishing its administrative stranglehold on the Strait of Hormuz, and the issuance of restrictive navigational guidance by industry associations will keep insurance premiums at prohibitive levels. Consequently, the structural inflation currently impacting global commerce is locked in for the medium term. This reality ensures that Chairman Kevin Warsh's Federal Reserve will maintain a highly restrictive policy stance, completely eliminating any possibility of an interest rate cut for the remainder of 2026 as the global economy adjusts to a permanent premium on trade resilience.